Apartment syndication is a method of pooling capital from multiple investors to purchase large multi-family properties, like apartment buildings, which would typically be too expensive for a single investor to acquire. The process involves collaboration between active and passive investors, each playing distinct roles in the acquisition, management, and profit sharing. Here's an expanded look at the fundamentals of apartment syndication, how it works, and the roles and benefits for each player. The syndicator, also known as the general partner, GP, is usually an experienced real estate investor who identifies a suitable multi-family property to acquire. The GP performs due diligence to ensure the property is a good investment, analyzing its financials, assessing the market, and determining the potential for cash flow and appreciation. Structuring the syndication. Once a deal is found, the syndicator creates a formal legal entity, typically a limited liability company, LLC, or limited partnership, LP, through which the property is purchased. This structure provides liability protection for all investors. Raising capital. The syndicator raises equity from passive investors, who become limited partners, LPs, in the syndication. These investors contribute the majority of the capital needed to purchase the property, typically in exchange for an ownership stake and a share of the profits. Acquisition. The syndicator secures a loan for the property, using the combination of debt from a lender and equity from the investors to fund the acquisition. The syndicator typically makes a small capital contribution themselves, which helps align their interests with those of the passive investors. Ongoing management. After the property is purchased, the syndicator oversees its operations. This includes hiring property management, executing any value-add strategies, like renovations or upgrades, managing expenses, and ensuring the property meets revenue targets. Distributions. Over the life of the investment, the syndicator distributes income from the property, primarily from rents, to the limited partners according to the terms of the syndication agreement. These distributions are often made quarterly and provide passive investors with regular income. Exit strategy. After a few years, typically 5 to 10, the syndicator may sell the property or refinance it. The sale or refinancing allows for a large distribution to investors, returning their initial investment along with a share of the profits from appreciation. Roles of key players in apartment syndication. Syndicator, general partner or GP. The syndicator is the active manager and leader of the syndication. They are responsible for sourcing the deal, raising capital, acquiring the property, overseeing operations, and eventually executing the exit strategy. The syndicator's responsibilities include finding and evaluating the deal, negotiating the purchase terms, securing financing, creating and managing the syndication entity, LLC, LP, handling the legal, financial, and operational aspects of the deal, and communicating with investors, providing updates and reports. Compensation. The syndicator is typically compensated through acquisition fees, paid at closing, asset management fees, a percentage of the property's gross income, and performance-based profits, often called the promote or carried interest. For example, the syndicator may receive a share of profits after investors achieve a preferred return. Passive investors, limited partners or LPs. Passive investors contribute the bulk of the capital but are not involved in day-to-day operations. Their primary role is to provide the funds needed to purchase and operate the property. In return, they receive a share of the property's income and appreciation. Their responsibilities include performing due diligence on the syndicator's track record and the deal's projected returns, committing capital to the deal, and staying informed by reviewing updates from the syndicator without having any active management duties. Compensation. Limited partners receive a portion of the profits, typically in the form of preferred returns, a minimum return on investment promised to passive investors before the GP receives their share of profits. For example, an 8% preferred return means investors are entitled to an 8% return on their invested capital before the syndicator starts taking performance-based profits. Profit splits. After the preferred return is achieved, profits are often split between the syndicator and the investors. A typical split might be 70% to LPs and 30% to the GP, though it can vary. Benefits of apartment syndication for syndicators, GPs. Leverage other people's money or OPM. Syndicators can buy larger properties and grow their real estate portfolios faster by pooling capital from passive investors. Ownership and fees. They earn equity in the property, management fees, and a share of the profits without putting up the full amount of capital themselves. Scalability. With more capital, syndicators can access better deals, enhance operational efficiency, and achieve economies of scale by managing larger properties. For passive investors, LPs. Access to larger, high-quality deals. Apartment syndications allow smaller investors to own a portion of large, institutional quality properties they might not be able to purchase on their own. Passive income. LPs receive regular income distributions without having to manage the property or deal with tenants. Diversification. Syndications give investors the chance to diversify their portfolios, either geographically or by asset class, without the time and effort needed to own properties directly. Tax benefits. Investors can enjoy tax advantages from depreciation and other tax strategies associated with real estate ownership. Key benefits of apartment syndication. Risk mitigation. Syndications allow investors to spread their capital across multiple deals, reducing their exposure to any single property. Economies of scale. Larger properties typically offer better economies of scale, leading to more efficient management and potentially higher returns. Potential for higher returns. With both cash flow from rents and appreciation from property value growth, syndications can offer attractive risk-adjusted returns. In conclusion, apartment syndication is a powerful investment strategy that allows syndicators to leverage investor capital to acquire large multifamily properties, while passive investors benefit from the returns of real estate without the headaches of property management. It's a win-win structure for those looking to scale in the real estate market.